Hey, so you've been hearing all about the banking system collapses all over the news, everywhere you read, everywhere you look, and you're wondering like, what is going on? Why are banks failing? And how does that impact the real estate market? And that's exactly what we're gonna cover in this video, and we're gonna get after it right now. Hey, if this is your first time to the channel and you want to know everything there is to know about eating, sleeping, working, playing the good and the bad of living in Atlanta, Georgia, then subscribe below and ring the bell for notifications so you can be the first to know when we release new content just like this. More importantly, you can stay up to date on the market, what's going on and how that impacts you. My name is Denny. The team and I get calls each and every day from people just like you looking to make the move to Atlanta, and we absolutely love it. So whether you're moving next week, next year, or anytime in between, call, text, email. Our favorite is to schedule a Zoom, and we'd be happy to help you make a smooth move to Atlanta. As I mentioned in this video, we're going to be talking about the banking system and how it impacts the real estate market. You've probably heard of the SVB, the Silicon Valley banking collapse, and maybe wondering not only how it impacts real estate, but what in the world happened? Like, how does that happen? And more importantly, like, how's it going to affect the rest of the banking system? Because Signature Bank, as well as Silvergate, First Republic, PacWest, then across the sea, Credit Suisse, all these banks are struggling and failing, and larger banks are coming in, swooping in to kind of help shore up some of these smaller regional banks, but it's one after another, and you might be thinking, well, are all these banks bad? Like, how did this happen? So let's dive into it right now. So we're gonna focus on the SVB collapse because that's probably the one that people have been talking about the most. That's Silicon Valley. Now, it is the 16th largest bank in the country and the first of like really big collapse or banking failure since 2008 when WAMU collapsed, Washington Mutual. And so how did it get to be that big? Well, first of all, to give you some context, Silicon Valley, as you probably know, is the hub of tech companies. And so believe it or not, this particular bank was one of the, if not the #1 source of venture capital funds for all of these startup tech and biotech companies. And that's really what made them grow to the size that they are. Rewind just a few years ago in 2019, and they were the 34th largest bank in the country. And then as the tech industry and the stock market and all of those things boomed, so did the deposits. And it was that influx of cash that took them from the 34th largest bank to the 16th largest bank in 2022. In 2022, they were accounted for 44% of the IPOs, the initial public offering of tech and healthcare, biotech companies that came to market. 44% of them got their funding. They were clients of SVB. And so that's really where a lot of their growth came from, which was great at the time. But the tech industry, as you may have noticed, has been suffering lately. There's been lots of layoffs and job cuts, and they're not doing as well as they were a few years ago. The stock has been down, and so when that happens, those same clients that were putting all of their money in started to rapidly take their money out, and that's where the trouble started. Over the last few years, their deposits and assets had swelled to over $200 billion, around $210 billion, depending on the timing that you look at. And so when all that money comes into a bank, what do they do with it? They don't just keep it in the bank, they actually deploy it so that they can earn interest, which is where they get their profits. You see, banks take the money you deposit and they pay you a small interest rate for your checking account or your savings, and then they invest that money in other places. And so some of those are short-term investments, which are available to sell at any point in time, and they have liquidity and they can get access to that capital, but that gets, a really low return. And so a lot of it goes into US Treasuries and mortgage-backed securities, and it goes into longer duration investments that could be 5, 10, 15, 20, 30 years so that they can get a higher yield, so that they can make the difference in what they pay the depositors for and what they earn on their investments. And so that's really where they create that spread, they create those profits. And normally that's a low risk proposition, these long-term T-bonds or mortgage securities. However, that's only in an environment where interest rates are stable or even falling. You see, one of the risks you run in these longer duration investments is called interest rate risk, because they move inversely from bond prices. And so when interest rates rates go up, the value of these investments go down, which is fine if you don't need to access the capital. But you see, that's not what happened. All of these clients from these industries that started to suffer started to request to withdraw their money. And they were requesting withdrawals faster and at a larger amount than the bank had to actually cover the request. And so they had a liquidity problem. Now, they decided what they were going to do to solve this is they didn't want to sell those investments at a discount and lose money. They wanted to hold them to maturity. See, this is another dirty little secret on their balance sheet. If they hold till maturity, even if they've lost value, the bank doesn't have to realize those losses. It's just they don't have access to the capital now. But when these withdrawal requests come in and they need the capital, they decided that they were going to just raise some money. And so with that, they disclosed, as all public companies do, that they had like a $1.8 billion loss or something crazy like that. And they were going out to the market and they were gonna raise almost $2.3 billion through the sale of stock. And that freaked the markets out. So instead of solving a problem and getting some liquidity, what they ultimately did is they created panic. They created a problem, and now people started to ask for their deposits. They started to make withdrawals faster and faster and faster. And even some financial planners and managers of these wealthy clients were sending out emails to all their clients saying, get out now, get your money out of SVB. And when they did that, it created what's called a bank run. Now, you may have heard that in the past and seen long lines during, the Depression or the other stock market crashes like in the 70s, where people were literally standing outside of the bank waiting to get in and ask for the money. But in 2023, you just press a button and you wire the funds out. You just request it. And so $42 billion were requested to be withdrawn in one day. Now, if you already have a liquidity problem and you're trying to raise $2 or $3 billion to help, losing $42 billion in deposits in one day is a massive problem. So in case you missed it, I want to circle back. You've got this inflow of deposits. The bank takes in all this money. They deploy it into these long-term investments, and interest rates are really low. From 2019 to 2022, they took in all this money. They grew to the 16th largest bank. Then everybody starts asking for that money and they need to get it back. But here's the big problem. As you know, over the last year, the Fed has been raising rates and the value of those bonds moves inversely. So every time the Fed raises rates, the value of their portfolio got lower and lower and lower. Now they have these withdrawal requests and they don't want to sell those discounted investments, those bonds. And so they go to the stock market. Stock market doesn't like that they're trying to raise money. It crashes. Now they are in a real big pickle and they need money desperately. And these assets are devalued. They've gone down so much that the federal government, there's two things that happens. Like the FDIC stepped in because they realized that the bank couldn't make good on these withdrawal requests. And the FDIC, as you may have seen on all the stickers on all the banks, they insure deposits up to $250,000. Well, 94% of this bank's deposits were uninsured. That means 94% of the money in this bank was over that $250,000 limit, which meant all of those people were going to lose their money. And so the FDIC stepped into really as a crisis of confidence to try to rebuild confidence, not just in that bank, but in the banking system, stepped in and said, we will cover everyone's deposits to unlimited amounts. You would hope that that would help, right? The second thing they did is they created the Federal Bank Term Program. And here's what they said. All of those T-bills, all of those mortgage-backed securities, all of those long-term investments that had gone down in value because the Fed raised rates, we will buy those from you for what you paid for them. Think about that. If you and I have a stock portfolio and it's down 30%, no one steps in and says, we'll give you 100% of your money back. But they said, we'll buy them for you, and then we'll just hold on to them until they get back to value or until they mature so that we can extract that back. But it would give the bank liquidity. So really they decided to waive the max FDIC insurance from $250 to unlimited amounts, and they decided to give the bank a cash infusion because they're buying off all these long-term bonds at the price that they paid for them, and then they're going to hold it. Now, one of the things that frustrates me about that is like, okay, so now the taxpayer's going to be paying for this bank's failed risk management. Side note, a lot of banks that manage their risk properly, they buy investments that hedge against inflation or against non-inflation interest rate risk. So when something like this happens, as interest rates move up and the bond values move down, then this hedge actually offsets that difference so that you don't have this big gap, so you don't find yourself in the situation that they did. For some reason, and I still haven't figured this out, over the last couple of years, SVB had completely eliminated all of their hedge positions. It had gone down and down and down, and in Q4 of 2022, it was zero. They were not hedging basically at all, so they were fully exposed just in time for this to happen. And why you would do that in a Fed tightening cycle where they're actively raising rates is beyond me. So something smells fishy. You just had like the stars aligned, and then it started to bleed out into these other small banks. And so Silvergate and Sovereign Bank, a similar situation but in crypto. But this has now just created a crisis of confidence in all regional banks. So everyone's going to their local regional bank and they're asking for their money back, and they're taking it to the big banks. Bank of America has $15 billion in deposits in the last week, and in all of the major banks, all the big banks are getting these inflows, and then it spread globally. So Credit Suisse found themselves in hot water. They've been declining for years, and then because of the crisis of confidence, they can't survive, and so UBS has stepped in to buy them. This has become a global issue. Now the Fed and all of the international monetary policy, from all countries all around the world are coming together to try to figure out how they can create liquidity in the market so that we can keep it moving, because if it completely jams up or collapses, we're all in trouble. So we don't want to have that. So one, I would say, hey, let's not yank all of our money out of all of these banks. Unless you have more than $250,000 in one account, then you're covered. Everyone taking all their money out is really exacerbating the problem. We're making the pain worse. Now, I'm not defending the government. I rarely think they actually do a good job at, keeping the market from booming or busting or inflation, or they just make it work. But at this point, they're making poor decisions and we're making it worse. So what does this mean for you and me in the real estate market? Well, time will tell, but I can tell you this. We don't have to worry about it unless you have $250,000 or more in your bank account. All that's covered. But from a real estate perspective, what this will do is it will create stricter lending requirements. If banks start to get stricter in terms of the money they lend, and if the overall banking system fails or it comes to a halt, well, then there won't be a lot of money for mortgages. There'll be less mortgages, which means less liquidity in the real estate market for it to sell. There'll be less money for businesses, so less investment, so a slowing economy and a bigger recession. It could be the trigger to a massive stock market and real estate collapse, or it could be what it has been for years and years and years. It's like one reason after another that the average person or the normal person would think is enough to make any market collapse has just been shrugged off, and prices stay high and the market goes up and business keeps moving. And so I don't know exactly what it's going to do, but I do know there is a lot of uncertainty around this particular issue and the banking system. But the central planners, the US government, the global governments, they are all trying to work together to basically shore up the loss of credibility in banking and the loss of confidence in consumers. So that's where we stand today. I think here in the US, the Fed is probably going to go ahead and raise the rate a quarter of a point, like they have been implying that they're going to do, because they don't want to communicate fear or panic, even though I think they are scared and I'm not sure they know what to do. Then I think they'll pause for a while, and then I actually think they'll reverse course and start lowering rates again, because this has definitely created some doubt in the overall stability and confidence in the market, and that's the last thing that they want to do. So again, they're balancing inflation, rates, jobs, economy, all those things, and that is not an easy thing to do. So we'll see how it all plays out. Stay tuned. If you haven't already, do me a favor and subscribe below, ring the bell for notifications so you can be the first to know when we release new content like this. And as usual, whether you're moving to Atlanta in the next week, year, or anytime in between, call, text, email, schedule a Zoom. We'd be happy to help you make a smooth move. And until we see you in person, we'll see you on the next episode.